Welcome everyone. My name is Denzel Rodriguez. If you're brand new to this YouTube channel, welcome. Happy to have you here. Today is a video specifically covering the velocity banking concept and the perception, the perspective that some people have on the internet. Lately, in the last few months or so, the topic of velocity banking has been picking up a lot of steam from the perspective of it being a scam. So what I want to do in this video, as someone who teaches the strategy, someone who has been practicing it myself for over 8 years, someone who has coached literally over 1,500 families do this strategy for a period of time and then stop, and even coached people not to do the strategy when it doesn't make sense, when it does make sense. I want to break down different aspects of this concept, the environment, the ecosystem in the velocity banking world, and just gonna give you that full context without being biased. Again, raising my hand, letting you know, like, yes, I'm pro of the strategy. I use this strategy. I've had tremendous results. My life is vastly different understanding this concept. I'm going to set all that aside and really just objectively break down the different pieces of the strategy. So for those of you who are genuinely interested, okay, there's folks that will never use this strategy, believe wholeheartedly that this is a scam. Perfectly fine with those folks. Have a nice day. Thank you for stopping by. Thank you for checking out my videos and uh, calling me a scammer. That's totally fine. I respect your opinion. Then there's people in the middle who are genuinely curious, skeptical, perfectly fine. I was too, and want to investigate this strategy fully and thoroughly to determine whether or not this can benefit them either in a season, in an emergency, or if it literally becomes their way of operating their finances. So with that being said, let's take it to the whiteboard and let's break down the aspects of velocity banking. Let me start with by saying velocity banking is a marketing term. There is no product. I can't walk into a bank and say, give me velocity banking. That doesn't exist. So it's not a product. It is a marketing term. It is a concept. It is a way of operating your personal and or business finances. Now, the word banking has products. Velocity, banking together, there's no product. The word velocity is referring to speed, direction. Banking is referring to an institution. So there are banks all across the United States, major banks, large banks, national banks, regional banks, federal banks, credit unions that offer these products here. Credit cards, personal line of credit, business line of credit, first lien, home equity line of credit, second lien, home equity line of credit, and a cash value line of credit. These are all legal and lawful products that we Americans use all day, every day. No scam there. So we should be clear so far on the product that gets used to implement the concept is going to be one or all of these products. And I have clients, I myself have all of these products, have had all of these products except for a second lien home equity line of credit. I currently own a first lien home equity line of credit on my primary residence. I have a business line of credit. I have a personal line of credit. I have a bunch of credit cards, personal and business. And in the past, before I obtained the first lien HELOC, I had a cash value line of credit. And I used a whole life insurance policy, the cash value in there, approached two different banks. I've worked with two different banks in the past, and they issued me a personal line of credit that was backed by the cash value in my whole life. All right. So there should be no arguments there in terms of these are legal and lawful products. Now, let's dive into the strategy itself. So let's say you have a personal line of credit, and what you're going to do to incorporate the strategy effectively and efficiently is you would have your income, personal and or business, depositing at the same location that your personal line of credit or business line of credit is at. I'm in South Florida. I'm going to name a bank in South Florida called Space Coast Credit Union. Space Coast Credit Union offers home equity line of credit, credit cards, personal line, business line of credit. So if I have my W-2 paycheck going to Bank of America instead of Space Coast Credit Union, step one for me would be to preferably move that income from Bank of America, move it to a checking account at Space Coast Credit Union. And you pair that with the personal line of credit, which is going to be a second account where I log in and I will see personal line of credit, I'll see checking account. Now, the core of the strategy on a day-to-day operation with your finances is the idea that your income typically lands in a personal checking account, and that will continue to be the case as it pertains to a personal line of credit. Now, at the same bank, in this example, Space Coast Credit Union, I can have communication with my checking account and my line of credit. My line of credit, when I first obtain it, is going to have a zero balance, and there's going to be a credit limit. Let's say you have a credit limit of $15,000. So that's your credit limit, and there's a zero balance on it. Nothing owed, and it is revolving, meaning I can withdraw, transfer money out of this line of credit into my checking account. So if I make $5,000 a month, W-2, bi-weekly, let's say, 2,500 lands in my checking account before I spend that $2,500 on bills, debts, and expenses. The idea where velocity banking can come in and be effective is when the individual that's making this money has some sort of a debt and they want to eliminate that debt. They want to accelerate that debt faster than making extra payments. Extra payments, or in other words, debt snowball, debt avalanche, or cash flow index, are commonly known strategies to accelerate debt in the form of essentially just making an extra payment, either toward your smallest debt, your highest interest debt, or your highest cash flow opportunity debt. So that's cash flow index. Those are your three most popular, most commonly known ways of getting out of debt that does not involve taking on an additional risk like investing in a separate account. So we're going to set that aside, because another commonly way of getting out of debt is you simply take your extra money that you have, open up a separate account, could be a whole life policy, could be a brokerage account, could be a business account, and you're going to take that extra cash flow you have every single month. Instead of accelerating your debt, you're going to take on risk, whether that's starting a business, whether that's investing in real estate, whether that's investing in Forex, stock market, cryptocurrencies, and you're going to acquire an asset that would increase in value and or produce cash flow, and you're going to be earning a higher rate of return than your cost of interest on all of your debts over here. And the idea is once you've accumulated enough money in that separate account, you can then transfer that money out, pay off all your debt in one shot, or do it in chunks, and that is a different strategy. If we're not including any sort of additional investment. We're just looking at the individual's discretionary income at the end of the month on a month-to-month basis, or otherwise known as cash flow, money left over after all your bills and debts are paid. You have 4 remaining strategies: debt snowball, debt avalanche, cash flow index, velocity banking. Velocity banking is otherwise known as accelerated banking, accelerated strategies, replace your mortgage, paycheck parking, uh, velocity strategy, different names that people come up, mortgage acceleration. These are all marketing terms to attract the individual, to get them interested in something, get them exposed to new information, and then from there you make a decision. So coming back to my example here, the checking account and you have the line of credit, 2 separate accounts, but they communicate with each other. You get one login from the bank. An example, I'm using Space Coast Credit Union. And you have the ability to transfer money in and out of these accounts, which is legal and lawful. I can transfer money day in, day out, as many times as I want, in and out between checking and line of credit. The idea is you would take a portion of that 15 grand, instead of making monthly extra payments toward a debt you're trying to eliminate. The idea is you would take a lump sum of money out, also known as a chunk. If we're using banking terms, it would be a lump sum withdrawal or transfer of that 15 grand, and you're going to pay off a debt. The idea is the debt that you're paying off is at a higher interest rate or a higher cost of interest, and you're going to transfer that into a lower cost of interest or even a lower interest rate. Now, that most people know that as debt consolidation. Let's say you had a personal line of credit, the interest rate was 10%, and you had a bunch of credit cards over here that were averaging between 18 and 30% interest. By transferring $10,000 into the line of credit, you effectively eliminate the debt, you eliminate the payment, and you cut off the interest cost that you would have paid over here. You're doing it in one shot. That's a simple example. Other example could be, let's say you have $50,000 of credit card debt, and you're going to do it in stages, chunks of 10,000 or lump sum withdrawal of $10,000 in this example. Follow me so far? Completely legal and lawful to do this. This is otherwise known as debt consolidation. Velocity banking is a form of debt consolidation. Instead of using a debt consolidation company that comes with fees and costs and things like that, if I use this strategy, I can essentially leverage my credit score to obtain a better deal myself. And if I can run 3 to 5 grade math, which is all we're doing is adding, subtracting, multiplying, and dividing to determine whether that makes sense. Now, 18 to 30% is worse than 10%. No one's going to argue against that. Where the argument occurs and the word scam arises is when the line of credit's interest rate is at a higher rate than the debt that you're trying to eliminate. That is a valid skeptical question, argument to make, no doubt, which is why there are times where this would not make sense. If I flipped it and said 18% line of credit and 10% debt over here, well, 10% is better than 18%. There's never a scenario where it's gonna make sense to move 10% interest over to 18%. Now, people in my world who are self-proclaimed experts or people who are trying to teach the strategy may disagree with that. They may say, no, Denzel, actually moving 10% over to 18% is actually better, and here's why, and they'll go into it. Where I come from as a conservative who's teaching this strategy, I come from a conservative perspective to simply say, rather than asking the question or trying to manipulate the math and do a bunch of different things to make sense of moving 10% to 18%, the real question is, why do you have an 18% line of credit? Because your credit's bad. So when I'm coaching my clients and they have a very, very high interest rate line of credit, before I try to move anything in there, I'm simply asking the question, why do you have that high rate line of credit in the first place? Did you know there's another bank down the corner that's offering personal line of credit at 9.5%, which would be less than 10? Did you know that there's 0% credit cards over here for 12 months and 0% balance transfer fee? Why pay 18 when you could pay 0 or 9.5 or a home equity line of credit with an intro rate at 4.5% for the first 12 months or the first 6 months, or even a fixed home equity line of credit for the first 3 to 5 years, less than that 10%. So it's less about making the math make sense or manipulate or adding other aspects to make it work. That the better question is, why settle for the 18%? So I believe what's actually happening in the world of velocity banking is a whole lot of misrepresentation or misunderstanding. Less scam, more misunderstanding, misrepresentation, poor timing, or just flat out wrong, incorrect execution of the strategy. Because as we've established, the products that you would use are legal and lawful. The actual method, the operation of transferring money in and out of a line of credit and a checking account is legal and lawful. What's really the problem is misrepresentation. So here's an example of misrepresentation. Say you have a loan at 6%. Let's call it a car loan at 6%. It's a 5-year note. It is a amortized note, which means whatever the payment amount is on this car note will not change regardless of how many extra payments you make. If you had a simple interest car loan and you made extra payments, your monthly payment amount will reduce. That's the difference. When you're dealing with an amortized loan, it's a fixed payment for a fixed period of time with a fixed amount of interest that's been preset. It cannot adjust. All you can do is eliminate the interest when you make extra payments. Follow me? So run your calculator, open up an amortization loan calculator on your tab, type in 20,000, 6%, 5-year note. You're going to get $386.66 is the monthly payment. The total amount of interest that you would pay over 5 years at 6% would be $3,199.36. Period. Now, let's say you had an extra $500 a month to pay toward your car. So altogether, you're making $886 payments to your car, whether you do that all at once on the due date of the car, which would be ideal, or you make your 386 and then a week goes by or 2 weeks go by and you make another payment of 500 bucks. However you do it, the math will most likely get you to a 2-year payoff. So you shave 3 years off, total interest you pay $1,926. The very first month of you making that extra payment of 500 bucks, your interest cost would be $100. Now, the way I coach my clients, the way I explain things on YouTube as well in my videos, in order for the strategy to work, we want our cost of interest in our line of credit to be less than the net cost of interest making extra payments, not going off of the regular timeline. Because if you go off the regular timeline, you could say the line of credit strategy is faster. but you would be incorrect because you have to compare it to what your other self would do, just making extra payments. You have to use the same scenario, you have to make it more fair. So you have to say extra payments, $500 a month. This is your measurement, this is your foundation to compare against this strategy, because 100% of the time, velocity banking is not always going to work 100% of the time. It can work for a temporary period of time, temporary. And there's times where it can work throughout the whole entire debt elimination process. I determine based in month one alone. So I don't need to run the whole thing. I need to know month one, what's my net cost of interest? Month one, is it less than the month one of someone making extra payments? There could be a little nuance there. Again, when you start adding in different external things that you can do with the velocity strategy, I'll give that to my side. But again, I like to be conservative and just evaluate that aspect to help the client understand we're making extra payments. We need to compare 2 years. Can we beat 2 years using the line of credit strategy, using the velocity banking strategy? So say you have a line of credit 15% and you consolidated the whole $20,000 into the line of credit at 15%. Your first month's interest, if you do nothing, would be $250, interest only. So owe 20 grand for 30 days, you'll pay $250 in interest. That's $150 more than the person that is making monthly payments. Now, what could happen in this scenario is the line of credit strategy could potentially do better, but more than likely will get very similar results. In some cases, worse. It might be 2 years and 3 months or 2 years and 4 months. So, does that make the strategy a scam? No. I would say this is misrepresentation. Why is the line of credit at 15% is the question. Because the person's credit score is poor. So if I get them a better tool, the conversation changes. Does it not? Changes dramatically. So here's an example of correct use. Instead of using a personal line of credit at 15% to pay off a $20,000 car loan at 6%, why not get a credit card at 0% for 12 months, no balance transfer fee? And let's say that credit card had a credit limit above 20 grand or even right at 20 grand, and you consolidated the whole thing. So now what you did was you paid off the car. Number one, car's paid off. You eliminate the 6% cost altogether because you moved it to zero. It didn't cost you anything to do it, and you're going to make your normal payments of $886.66. Do that for 12 months, you would have paid $10,639.92, zero interest toward that vehicle. But now you have a problem. When that credit card expires, it's going to jump to a 20+% interest rate. You're going to have $9,360.08 left over. So what are my options? Well, within that 12-month period, if the opportunity is available, I could transfer to another 0% credit card. That's one option. I could obtain a personal line of credit at a much lower interest rate than 15%. Say we got 9 to 11%. Now I'm at 9. Say you're at 9%. We'll go in the middle, say 10% on $9,360 left over. There is a scenario potentially, but you have to add other factors for the math to work. Potentially, say you did the HELOC, $9,368, transferred out of the 20+% credit card, transferred into the line of credit, and depending on the person's income, cash flow, in combination with a credit card, running bills and expenses, floating, parked on a credit card, and cashback rewards, you could have that 9K eliminated before you hit the 2-year mark. So even though on the tail end you're at a higher rate, the thing you need to pay close attention to is, what is my actual cost of interest? What is my actual cost of interest each and every month? And you come back to the extra payment example, because you could say, okay, well, for the first 12 months of the person making extra payments of $500 on the 6%, month one they paid $100. The following month will be a little bit less. The following month will be a little bit less. You tally that up. We could take this 1926 and divide it into two, just under $1,000 of interest they have already paid. Over here, you haven't paid any interest yet. So you compare that. You say, so what's my window? Okay, this person's already paid about $1,000 in interest. It's been a year. I haven't paid a single penny yet in interest. I'm at 10%, even though my rate's higher than the original 6. I still haven't yet paid $1 of that interest yet over here. So I'm ahead. Extra payments is behind. What can happen is if the rate is too high, diminishing returns can catch up to the individual, mess them up, throw them off, and make them late, essentially past 2 years. So we want to have that line of credit, that 9 grand paid off before the 2 years. If we use some math here on 9,360 and 8 cents and divide it by that cash flow, 886.66, that's 10.5 months. So if all the person does over here, once they transferred that 9 grand into the 10% line of credit and just paid 886.66, they're going to get done right on time to 2 years. They might even be slightly past it, because I just did math saying 9,360 divided by 886 is 10.5 months. That's no interest. So I would need to continue to pay no interest in order to have this thing done in 10.5 months. So how does this strategy continue to make sense? Because in the beginning it made sense. Oh yeah, just transfer 20, boom, over here, pay the extra payments over, redirect that 386 and the 500 to the credit card and start knocking it down. But then it's going to expire. I don't want to jump to 20+%. If I have a PLOC is going to be at a much better interest rate than a credit card. But if all you do is make extra payments, you're going to end up at the same result. So now this is where the main function starts of checking account, line of credit, making sure that you're dumping all of your disposable income into the line of credit. So now you have a balance, right? 9,360 in the line of credit. You're making 5 grand a month, you're making 8 grand a month, whatever the number is, you want to be able to deposit that into the line of credit, because now what you're doing is you're cutting off the interest costs of 10%. You're reducing the amount of interest you pay on the balance owed. Because in a PLOC, the interest is not prefixed. The interest is unknown. It depends on how much you owed on a daily basis throughout that statement cycle. Okay? So that's, again, that may not even be the best solution here. Because what did I say earlier? I mean, hey, if I could transfer to another credit card, and even if I had to pay a fee of 4%, let's say, 9,360, 08 times 4% is $374. I'm still ahead, right? So if scenario one, if I can get another credit card at 0% for 12 months, pay a balance transfer fee of 4%, the person making extra payments is already at $1,000 in interest costs at this point, close to it, maybe even a little more. I've only paid $374 in interest. I keep paying $886 every month. I'll be done in about 11 months. So I finish 1 month sooner than the 2 years. Not a big difference. But did it do better? Yes. So now the most efficient option is when we can go from a higher rate, 6%, to a lower rate. So over here, say you have equity in your home, you're a homeowner, you got 9,360 left to pay off. Credit card's going to expire. Instead of transferring it to another credit card and paying a 4% fee, or transferring into HELOC paying 10%, what if you transferred into a HELOC with an intro rate between 4 and 6, below 6%? There's plenty of HELOCs out there today. I have a whole entire series on my channel going state by state showing intro rates in the second lien position. So let's say you had a 4.99 intro rate with a second lien HELOC, and you transfer that 9K into there. Now we can make the argument from going from 10 and a half months, well, again, that's just extra payments, to now potentially cutting that down another 3-4 months. So now I'm going about 4, almost 6 months faster. And again, it's a combination of a lot of things coming together. The right tool, the right rate, credit card usage, cashback rewards. You're going to be compounding your result, and the core function of parking all that income into the line of credit, because there's going to be months with that $9,000 balance left over. If you're making close to the amount you owe, there's multiple months where the balance on the line of credit is only like $1,000 or $2,000. Multiple days out of the month, I'm only being charged interest on what I owe. That's a far smaller number. And the goal is to keep your money as long as you possibly can in the line of credit until you have to pay your bills. And because it's legal and lawful to park all of your money in the line of credit, what happens with the line of credit? The line of credit starts to replace the function of a checking account. A checking account primarily expenses, right? Pays expenses and holds cash. A line of credit can do the same thing. It can hold cash and it can pay expenses by simply transferring the money back out to the checking. Checking pays the bill like normal. There are some lines of credits with banks that literally come with an account and routing number, or some that come with a credit card, which would mean I can keep my money in the account. I don't have to transfer it out. I can use this credit card to pay bills and expenses. Maybe not all of them, but a large amount of them. And by the time those bills register and get charged, all my money was sitting in the line of credit, essentially cutting off that interest cost altogether. So those are the major aspects of what I'm seeing in the online world today. People who are just flat out calling the strategy a scam, I'm never going to convert those people. I'm totally fine with that. The people I'm talking to are the ones who are in the middle. You are skeptical. You are inclined to do the math. You want to run the math. And you're seeking efficiency without taking on another level of risk. Okay, because if you compare a debt elimination strategy, which is a pure debt elimination strategy, versus an investment strategy, on paper, the investment strategy should win every day of the week long term. Should win every day of the week long term, especially if you make the right investments. Well, what happens when you make the wrong investment, or you sell too soon, or you don't invest properly, or you don't allocate that money every single month? You're still carrying the debt along with the stress that comes with it and everything else. So there's different arguments that we can go down. And when I'm debating others, I like to make that distinction to let them know you're making an apples to oranges comparison, and I'm going to yield to the fact that an investment strategy should outperform what I'm teaching here. The reality is most people are not ready to invest, don't have the knowledge or discipline to invest just yet. By encouraging people to eliminate certain debts, you don't have to eliminate everything, but to eliminate certain debts and get high rate of return on interest costs and guaranteed increased cash flow could boost a tremendous amount of confidence. And along the way, I can teach them, educate them about investments that are in alignment with their values and beliefs to help them make a better decision and create more wealth for their family and a long-lasting legacy. So I will close with that. If you have questions on the strategy here, comments, drop them below. You want to have a conversation with me. If you're someone that is on the scam side and you want to have a discussion, you want to rebuttal any one of my points here, I'm happy to go over it again and again and again and again, to say it differently. The other aspect that is an argument for sure is how the educators, experts, coaches are charging. So that's another argument for sure. You can say, well, Denzel, the strategy and all makes sense, but if I have to pay $10,000 for coaching to learn the strategy, how do we factor in the cost of that $10,000 into the debt elimination plan? That's a valid argument. Won't disagree with that. You can also argue the fact that, hey, charging $10,000 is way too much. I don't do that. I don't believe there's anyone in the industry today charging $10,000 for just this strategy. I don't believe that's the case. The top voices, the top experts in this industry of velocity banking, where that's their core service, Michael Lush, Kwok Brothers, Denzel Rodriguez, Christy Van, like there's a handful of us still to this day. We're working with tons of people in different capacities. And I would say Christy Van, myself, Kwok Brothers, Michael Lush, Replace Your University or Replace Your Mortgage, have packaged programs, have softwares, financial software that you can purchase that isn't predicated on one strategy. So if I buy a financial software that costs between $5,000 and $10,000, let's say, you are factoring in multiple layers because you're not just buying the software for this one strategy. Rather, the software is doing so many other things, like helping you make decisions about a vacation over this, calculate opportunity costs, track investments, track savings, track milestones and goals. Financial softwares that are, AI integrated and different things can help you find more cash flow in your economy, can help you spend better, spend more efficiently. So there's different value adds there, along with one-on-one coaching with a human being, along with courses and education on other topics, life insurance, investments, real estate, legacy planning, wills and trusts, you name it. That's what I'm seeing more of in our space, specifically those people I mentioned, Christy Van, myself, Michael Lush, Kwok Brothers, that when they have tiered programs that go beyond 10 grand, let's say, I personally do not have a program that goes beyond 10 grand. My highest program working with me one-to-one is $4,500, or if you pay in full, it's 4 grand. And I mathematically show people how they recoup that money over a period of time, in a very, very short period of time. And it's not just one strategy. I like to share and say that we velocity banking experts or self-proclaimed experts are not one-trick ponies. We know debt snowball, we know debt avalanche, we know cash flow index, we know velocity banking, we know life insurance, we know investments, we know leverage, we know credit building, business credit. We have access and we know a lot of these things. So what's the full value of working with someone on a one-to-one basis that, hey, maybe out the gate, it's not velocity banking. I can't tell you how many clients I work with where we're not doing velocity banking out the gate, yet they paid me that 4 grand, and we don't do velocity banking until 2 years out, maybe. because the math just doesn't make sense. So we're doing some other strategy. The real value of investing in yourself when you hire an expert, a financial professional, is not the information that you're going to learn. It's not the strategies that you're going to implement. It's not the exposure. It's the accountability. That's it. When you pay for accountability and you have that consistent communication with your coach, on paper, it looks pretty. Make $500 extra payments every month. You'll have your car paid off in 2 years. If it were that easy, so many people out here would be doing it. But the reality is that's not the case. Why? Life happens. Things get in the way. People get hurt, people get sick, people die, people change jobs, people lose jobs, people get injured. So making $500 a month payments towards your debts by yourself, DIY, good luck. I wish you the best. Some do very well. The majority do not. The majority need coaching. The majority need accountability, support, and being able to check in with someone and letting them know, yes, I made that payment, being encouraged. Okay, let's do the next one. Okay, let's learn this. Let's do this. Let's increase our income while getting out of debt. Let's pick up a new skill. Let's build our credit while getting out of debt. Let's do all these different things. That's what makes a tiered program package that people invest thousands of dollars in more valuable. So that would be my only pushback when the person over here is saying that the gurus are scammers. I would argue let's take a deeper dive into what they're offering. What comes with that $4,000 package, that $6,000 offer, that $10,000 offer? What are the additional things that come with it? For me, when people invest $4,000 or $4,500 over a payment plan, they're not only getting access to me, they're getting access to other partners that I have in different spaces. Yes, they're getting access to more information. Yes, they're getting access to courses and support. The main thing is accountability. People who hold themselves accountable get far better results than those who don't have an accountability partner, period, every day of the week. For the DIY people, again, some of you do well. Some of you watch this channel consistently because you DIY everything that I'm teaching and sharing with you, because I know the information I give is the same information people pay me for. So I'm giving everything I know for free because I know some people are going to do it, most aren't. The most aren't people are my people that I want to coach and help. The DIY people, guess what? Those are people, you know who you are, that are strategically positioned to potentially be teachers, coaches, professionals, and help others. Because you helped yourself, you stayed disciplined. Now you could potentially be in a position where you can teach and you can share that discipline with others and help others become more disciplined. And if they pay you for it, great. Or if you're in a position where you don't have to charge, great. I do that too. I work with people for free. People pay me. And then I do all this work for free on the internet. So hopefully this video was very, very helpful. You can share this with other people who are skeptical. At the end of the day, there's so many different ways to become debt free. So I don't have to pigeonhole a client into doing velocity banking. I never force anyone into the strategy. If it makes sense, we do it. If the math lines up, we do it. If it doesn't, we don't. We choose something else. Snowball, avalanche, cash flow index, life insurance, investing. Same thing, holding you accountable with whichever way. And we go from there. All right, my name is Denzel again, personal finance geek of the 21st century. Click links below. You can book a consultation with me. That's how most people start off. 1 hour call. Let's get the whole thing mapped out. Let's get an idea of the whole situation, which direction you want to go in to live the life you actually desire. Have a wonderful day. God bless, and talk soon.